which is up about 1.7 odd percent in the green as well. The Nifty is coming off a little bit. It's up 20 odd points now. We'll see. Timken India was locked up 20% yesterday. It's starting 2% lower, but there's not very much on volumes, at least at this point in the day. Hoodco is another one which is down 1.5%, but it's far and few in between. The momentum is, of course, with, at least this morning, stuff which is up on volumes in the broader market space. So 25 points, 18,366 is where the Nifty is starting at. Overall, I mean, it feels a bit quieter as compared to the open in the broader market we've had the last 2 or 3 sessions now. Our market master of the day is with us. Nilesh Shah is Managing Director of Kotak Mahindra Asset Management Company. Nilesh, welcome back on the program. Thank you very much for your time. It's been a while, so good to see you. There are 2 things. Oil is now under, last night it fell under $90, so it's a far cry from where it was, and that's perhaps the most important macro variable. But on the other hand, you've got, commentary from Fed officials, etc., again saying, there was one particular gentleman who said that, the terminal rate should be somewhere between 5 and 7%, which is, how do you see this kind of pan out as we head into 2023?
So I think, Prashant, market is used to Fed walking left and talking right. Most Fed officials have been doing this quite consistently. Even Fed's press release versus Fed chairman's press conference were into opposite direction. Press release was dovish. In press conference, he highlighted that terminal Fed rate will not be 4.63, but more towards 5%. He highlighted rates will be higher for longer. And he also highlighted if he has to make a mistake between keeping rates higher and creating recession versus keeping rates lower and not controlling inflation, he'll rather make the first mistake. So I think market is now well used to Fed talking left and walking right. It will be fair to assume that Fed is trying to buy credibility. They have been behind inflation for a long period of time. Now they have to make statements to buy credibility, but at the end of the day, they will be driven by data. Whenever they believe inflation is under control, they will be then focused on growth. And clearly, what data we are getting from US in terms of economic numbers, they are not that good. We believe 1 in every 6 American household is behind in payment of utility bills. Now, with that kind of scenario, I doubt Fed will have a lot of leeway on keeping rates higher for longer.
So what do you do here in this market, Nilesh? We are virtually at all-time highs. The momentum has picked up. FII buying has come back in a big way. Do you think we'll spend some time around these levels? Is it a pause that you're looking at purely because of the global concern? Or do you see more legs to this rally now?
So, Sonia, from a valuation point of view, we are now above our historical average valuations. This is kind of standing out in the world where most of the markets are trading way below their historical average valuation. It's difficult to understand FPI behavior. They have been selling when valuations were cheaper and they have been buying when valuations are expensive. From a valuation point of view, this is not the market which is very attractive. We are in marginal premium category. So you have to be stock specific. You have to keep dry powder for accumulating in case correction comes. And you have to be a long-term investor because now you are not investing for 6 months, 12 months, 18 months. You are invariably taking a 3-year and 5-year view.
Hi, Nilesh. Good morning. Nilesh, I listen into your advice, and for my kids, I don't miss a single SIP. I'm keeping it going, and I'm looking at it for a longer-term horizon. The problem is some part.
Thank you so much.
Before you pull me up on that front, but my question to you is: the fear is that maybe some part of this domestic money gets pulled back because real estate could be an attractive investment, or maybe some of these bonds, maybe not top paper, but maybe. Some of that paper is offering 8, 9%, 9.5% odd. I wanted your comment on that. I'm keeping the faith. I'm reiterating. But Nilesh, do you see this as a bit of a threat? And what's your comment on that?
Undoubtedly, Nigel. I think retail investors have matured way beyond foreign institutional investors. They have been buying when markets are falling and valuations are cheap. They have been booking profit when markets are rising and valuations are expensive. Collectively, as a retail investors, if we see their SIP flows continues at about 13,000 crore a month, but they have been booking profit and investing on a lump sum basis to ensure that in a falling market, there is SIP plus subscription flows, and in a rising market, there is SIP minus redemption flows. So I think retail investors have become fairly mature. They know what asset allocation means. And whenever they believe risk-adjusted basis, debt, real estate, or commodity markets deliver better return, they will certainly take profit from equity. So I don't expect that mutual fund flows will always be unidirectional going one way up. We will be driven by what kind of flows come to our kitty. And that's where I do see retail investors behaving in a fantastic manner. They manage their asset allocation far more than what they were doing 15, 20 years back.
Nilesh, just to take that asset allocation point forward, I mean, in a previous life, you were on the fixed income side as well, many years ago. Are yields attractive? Somebody was making this point that, I mean, these are not bad fixed income rates to lock yourself in for the next couple of years. If you don't have exposure on the fixed income side and you want to balance, asset allocation, would you agree with that, or you think yields are headed even higher, so one should wait a bit more? What's your sense?
If you are taking a one-year view, then certainly yields can go higher and probably impact your return. But if you are taking a 3-year view, then this is the level to invest into. Yes, in the short term, there could be some pickup in yield as US Fed, sets the direction. But we believe there will be ultra V kind of interest globally. What happened in Japan, where central bank for 30 years is keeping liquidity high and interest rates low, will happen in European Central Union, will happen in United States of America, will happen in United Kingdom and most of the Western world. At $30 trillion debt, 1% interest rate movement means $300 billion increase in interest cost. If interest rate goes up indeed from 0.25 to 5 to 7% as Fed is talking about, that's increase in interest cost of more than $1 trillion to $2 trillion. I don't think so American budget has that kind of flexibility to provide for that interest rate cost. Japan today can manage 225% debt to GDP ratio only because interest rates are zero. If interest rates goes to 5-6%, Japan will become bankrupt. So there will be ultra V kind of interest rate movements globally. Central banks will raise interest rates when inflation is going out of control as it is today. But they will soon start cutting interest rates in order to ensure that their government and country survives. Keeping that in mind, if you are taking a 3-year view, this is the level of yields to lock in. If you are taking a 1-year view, then yes, you can try to time in. My simple recommendation will be do STP in duration fund over next 3 to 4 months. There will be far more clarity by March 23 on interest rate scenario.
Within instruments, you already gave us the STP option. Should one look at corporate paper, slightly higher yielding instruments, etc.? I mean, just to dig into that a little deeper.
Prashant, my view is that you follow your risk profile.
Okay.
If you want to take risk, it's far better to take risk in equity than in fixed income.
Okay.
In fixed income, always believe that return of principal is more important than return on principal.
Got it.
Okay, got that. By the way, the market is very, very quiet right now, but it's still the PSU banks that are gunning from the front. Union Bank is up 2%, Bank of Maharashtra, Bank of India, a whole host of banks actually, both PSU and private, central bank, all doing well. Nilesh, a quick comment on banks. Do you think it's getting to be a bit of a crowded trade now, especially PSU banks, or do you think there's lots more to go on the upside?
So this is, Sonia, a very, very tricky scenario. Normally, experience teaches us that whenever there is a consensus, it is generally on the wrong side. There is always a surprise down the road which comes and impacts consensus. We have seen those kind of crowded trades in technology, media, and telecom in 2000. But this time on banking sector, fundamentals are supporting valuation. NPA levels have come down. As interest rates have gone up, margins have expanded. Liquidity is getting a little bit tighter, but it's not that tight that your credit growth or deposit growth will get impacted significantly. More importantly, valuations have corrected significantly over the years. So I believe it's a crowded trade, it's a consensus trade, but valuations today in banking system are not as expensive as bubble valuation in other sectors. So maybe there is some room for rally in banking stocks, both private as well as public. But one needs to be cautious that this is a crowded trade.
Okay, all right. Nilesh, one place that was very crowded was New Age, but that was a long 12 months back. Today, in fact, that's in minority, but there's plenty of supply that's there. Any view out there? Some of those businesses, well, they're well-run businesses. The problem is on valuations. But post this price correction, do you think some of them are getting to that, that zone where you want to have a look into it?
So, Nigel, this was a crowded trade from private equity point of view. It was not a crowded trade from a public market point of view.
Absolutely.
We really don't understand how this companies work. There were not many precedences in public market. We ourselves were learning how to understand these companies, how to, prepare business model for them. And all of us probably invested small sums of money in order to keep a watch and in order to learn. Now, I believe over last 1.5 years journey, we have accumulated some knowledge. And I think public market investors will start differentiating between men's and boys. There will be new age companies which will be rewarding investors over a period of time from this level. And there will be new age companies which will still destroy shareholder value from this point of time after 50, 60, 70% correction. So men's will be separated from the boys. People will have to bet on their conviction. There will be more volatility in new age company than other sectors or other companies.
Okay, all right. Nilesh, we will leave it at that. Have a great weekend. Thanks a lot for joining in on the show. Let's move on and talk about the real estate space. Sobha is on our radar after its Q2 earnings. Volumes were flat compared to last year, but the company has clocked in its highest ever quarterly sales value and collection. Sobha's average realizations have also increased 12%. And another positive news, the declining debt trend also continues. Jagdish Nangineni, the MD of Sobha, joins us now to talk about that. Mr. Jagdish, thanks a lot for joining us.